Ooh, welcome back to Real Estate Mindset. Good morning. Happy Monday. Thank you for joining me on the start of the week. Hopefully, I'll get you guys equipped with handling the rest of the week. That is my goal. And I want to start the video out. First of all, I have a lot to cover. We're going to listen to Jerome Powell, 60-minute interview that he just did. We're going to go into the true cost of refinancing. I'm going to finish out the video as well with a market analysis because I have people ask me all the time, how do you find a great deal? What is wedge? What is cash flow? But before I do that, let me tell you guys about a member of our community on Discord. And I'm not going to use the name. Let me see if they're on there. Let me know if my audio is okay. Good morning to all of you. Where is everyone? There's Sheldon. Good morning, Sheldon. Good morning, Trey. Good morning. Let's see here. Cameron, WTH, there you are. Florida Beach Bum is on as well. Volvo's here. Young Betty, I love you guys so much. I'm not going to do this without you guys, so don't forget that. Don't forget how much I value. Limit the live stream to 3. Come on, Johnny. Jeez, look at Johnny's got. Go back to sleep, Johnny. He's out in the West Coast, so he's got a 2-hour time difference. That's why he's a little bit grumpy without coffee. Am I right, Johnny? Did you have coffee? Where's my hipster glasses? Those aren't hipster glasses. Where are my glasses? I don't even know where they're at. Anyways, guys, let me start off by, talking to you guys about kind of a cautionary tale. I had a member. Okay, I always try to look at my comments. I try to respond, but I have to protect myself from being burnt out. You guys, when I get burnt out, I start trolling the trolls and I just become a mess. So I got to balance myself. I am trying to respond to every single comment because it does mean a lot to me. But anyways, I had a member comment that they just went under contract to buy a house. So I was like, okay, go to my Discord, go to the Discord group. It's free. Reach out to me and I'll try to do a market analysis on the property. So he joined Discord and he messaged me privately. It took me about a day or two to get back to him, probably 2 days to get back to him. And my first question was basically he had put an offer on a new construction house. And my first question was, did your realtor run a market analysis on the subdivision? And he said that he wasn't being represented by a realtor. And I was just like, my heart sank. And then my next question was, okay, all right, well, that's scary, but because it's a new build, right? New builds are very dangerous. The lack of consumer protection in new builds or the transaction to purchase a new home, I can't overemphasize how safe you have to be. So anyways, he didn't use a realtor. And then I asked, what was his earnest money deposit? And he said, $17,000. And I was like, oh my gosh, $17,000. And then my next question was, how long is your option period? Your option period in Texas, at least, depending on the contract, allows you to walk away from the property for any reason. So that's generally a time when you get inspections. You generally get inspections done during the option period so that you know whether or not the house is in good shape. So what he told me was, there's no option period. So I was just like, okay, so this is what you're telling me. You're telling me that you just purchased a new construction home without a realtor with a $17,000 earnest money deposit, which normally it's 1% in Texas or less. So it should have been $4,000, but they got him for $17,000. And I was like, and what you're saying is you're locked into the contract and you have no ability to cancel, right? And he's like, yeah. And he's like, but I knew that going in. And I was just like, oh, dude, that means that they can do whatever they want. And I was like, are you also using their lender? And he's like, yeah. So this man has given them full control of his livelihood. And he's a member of our community. He's an original member of our community. So I'm like, hey, if you're part of Real Estate Mindset community, you better be purchasing. If you're going to purchase real estate right now, there's a big if there, which overall, I don't think people should. But if you are, you should be a great buyer that is empowered, that understands wedge, cash flow, proper expectations, and things like that, right? So I started the conversation out freaking out, right? I mean, this guy has no protection. He's a member. I'm already feeling sorry for him. But here's the good news, okay? He's like, Travis, I think he said this. I have to go back to the Discord. He's learned a lot and whatever. And so I ran a market analysis on the subject property subdivision. And what I found was, first of all, the problem was it was a new subdivision. So we didn't have comps going 2 years back or sold properties. So all I can base his purchase on is active listings, which is not what you want to do. We did find 3 properties that sold over the last year, though. And basically what we found out was, so this is a good thing, okay? So he ended up, so far, other than being locked in the contract, he ended up getting the property for over 20% under what's actively being listed. So that was some positive news, but nevertheless, it freaked me out because I was like, he's going in all alone. So I'm telling you guys this story because he really put himself in a situation he's completely at the mercy of the builder. And that's not a good thing. But Even with that, he had the right expectation. He knew, he's like, just, I know that I can't walk away. I'm like, dude, that's dangerous. He's like, I know those things. I had a real estate attorney review the contract, but the price I got was great. So all I'm saying, guys, is you can negotiate on your own, but it is very, very dangerous. And I don't know if I would ever recommend that. So he appeared to have won. Hopefully he did. Good morning, everyone. It's not Trey. You guys are like, Trey, do your due diligence. I mean, he did, from what I could tell, Dean, he did do his due diligence because he did get it accepted for about, I think it was 22% under market, and he did it by himself. So that also shows like, hey, we don't 100% need realtors. This man went in one of the most difficult transactions, which is new home construction, and he went under contract. He actually locked himself in. That's bad and horrible, but he got it for 22% under what was listed. Props to you. I won't use your name and I won't tell everyone where that was, but I just wanted to give that story. So we're going to go into our mortgage rate update. We have had massive movements in the market. We're going to start with looking at the 10-year because remember, the 10-year Treasury tracks residential mortgage rates. So here's where we're at. You guys ballooned. I mean, skyrocketed. So this video title is appropriate. Rates will skyrocket. They went up drastically when we ended Friday. They're also going to go up drastically today. You can see the movement. This is abnormal, by the way. So the movement on the 10-year, oh my gosh, we were just at 3.88. Two business days ago. I think we started the morning at 3.88. It's now at 4.11. It's up almost 10 basis points in one day. This sucker is ballooning. This is the economy crippler right here, that longer end of the yield. When the rates are lower than the shorter end, it's crippling. So this is crippling the economy. Economy is still resilient because of the bank term funding program. Obviously, that was a massive injection for the finance market, but we have other areas of liquidity that I'll go over in a second. But anyways, that's what the 10-year is doing. So rates are going to balloon up. Mortgage rates will balloon up, and that's exactly what we want. Here's the 2-year. The 2-year's up also almost 7 basis points. So it's not as high as like the 10-year, but nevertheless, it's up. It's up basically almost 7 basis points. Okay. And basically the fact that this is going up faster than the 2-year is what's known as a bear steepening, okay, which is an uninversion of the yields. And a bear steepening actually signals that we could potentially be in a strong economy. What we'll know is if we're going to be in a strong economy, we're able to handle high interest rates, not the other way around. So understand that. So if we have these high interest rates for longer, and the economy is, but then I would argue, is the economy really doing great? We'll look at the job numbers as well. Let me move on to the mortgage rates. Okay, so here's where we're sitting at mortgage rates, you guys. You guys can see in one day they ballooned up. So we were sitting on Thursday at 6.63. When we ended on Friday, they ballooned all the way up, like massively, to 6.92%. I'm going to tell you guys right now, you guys, I'll put my money where my mouth is, but we're going to end today in 7%. Mortgage News Daily, when it updates later today, you will see residential mortgage rates in the 7%. This is a live video. You guys can check this for yourself. I am convinced you will see 7% once again at the end of today. But when we look at the year over year, you guys, I mean, everyone's like, oh my God, the home buying demand. Look at where we were last year. I can't quite get there, but we were sitting at 6.39% this time last year, which means, I mean, obviously almost over 50 basis point higher, half a point higher than we were last year. So things are more unaffordable. Things are more expensive. And I'll show you guys inventory. Inventory is up 15%. Did y'all know that? Did y'all know that inventory is up 15% year over year? Where's the headlines at on all this stuff? Let me show you guys the amortization schedule, and then we're going to go into the true cost of refinance, and then we'll go into the CME. So here again is the amortization schedule. This is so important to me to get you guys to understand these amortization schedules, because a mortgage can be some of the worst debt in America, credit card debt being the worst debt. But the reason why mortgage debt is so bad is because of what you see on your screen right here, which is called an amortization schedule. Now, when I put in the average interest rate of 6.92% at the average loan amount of about $324,000, you see that your total amount of fees on the $324,000 is $455,000, which means your true interest is 130%. But it gets even worse than that because you pay a lot more interest than you do principal. You guys can see I've highlighted on the first year how much interest you pay compared to how much principal. So the first year of payments, you pay $22,300 in interest and you only pay down $3,300. So if you really want to impact your mortgage and you really want to be a winner, you got to buy pay the principal down. So what I wanted to show you guys is basically by paying the principal down about $20,000, it's a little less than 20,000, it's like $19,276. Okay, you guys save all of this interest. You save over $100,000 in interest. Y'all see that? So if I pay 20,000 roughly, I save 5 years and all of this interest. This is absolutely amazing. I hope you guys understand this because I want you guys to be winners, and we can't be winners if we're going to keep our heads in the sand, staying a part of the rat race. I mean, come on, guys, you know that, right? So let's look at CME because obviously Jerome went on 60 minutes, and obviously, you know, with the Fed minutes, I mean, how like crazy is it that this is always wrong? The market is literally never right, unless it's like right before. But here's what the market is saying as far as what's going to happen next with residential mortgage rates. I'm sorry, federal funds rate. So what it's saying is there's almost no chance of a rate cut in March. Round of applause. Do y'all remember how many people were freaking out? And I said, we need to make it to June to stay ahead of the spring home buying season. So far, so good, right? Despite how the market flipped the other day. Now look at May, you guys. Okay, here's May. Okay, so even May is saying 32% likelihood, no rate cut in May. Do y'all hear me? Now it's 32. We weren't even pricing in staying at the elevated rates in May. Do you guys remember? It was like there are going to be massive rate cuts in May, massive rate cuts. Now there's a 32% likelihood there's going to be no rate cuts in May. Do y'all see that right there? Isn't that amazing? Look at June. This is where I want to make it. If we can make it to June, I think we're going to be in okay shape. I think we definitely need to make it to June. I've been saying that for the last year. And so far, here's what the market's saying. We have to make it to June, which would be epic. We want it to make it to June. Elevated rates to June. No rate cuts because little tiny rate cuts are going to mess with people's minds. And we know emotions are very powerful in the housing market. So we don't want people and we don't want consumers to have their minds messed with. We want consumers to be patient, making good decisions, like most members of Real Estate Mindset are, by the way. But they're saying only a 5.4% chance to stay elevated in June. This is beautiful because the other day was a 60% chance of 150 basis point in cuts, or I think 75 basis points in cuts. So the fact that they're now pricing in the possibility that they don't even cut in June, that's a good thing. That's what I want anyways. I don't know if you guys want that, but that's definitely certainly what I want. Let me go back over on this screen now, you guys. Now, what I want to do is I'm going to attempt to show you guys the true cost of refinancing, because what do we hear a lot? We've been hearing a lot that, we've been hearing a lot of things. Date the rate. I'm sorry. Yes, date the rate, marry the house, right? And just refinance later. But I want to explain, to you guys in a way to where I compare it to renting. Because the reality is if you bought a house in the last year or even the last 2 years, and your plan is to refinance into a lower rate, generally, if you do that, you would have been better off renting. And the reason that is because it costs a tremendous amount of money to refinance, and you start your amortization schedule again. So if we really want to, compare the buying versus the renting debate, we really got to look at the fact that most people are expecting to refinance, and by doing so, they literally shoot themselves in the foot. I'll say they shot themselves in the foot by even buying recklessly, but nevertheless, let me show you guys. Let me tee this up real quick here. Okay, so this looks a little confusing, but I'm going to go over it with you, so don't worry. And you guys should be having a much better understanding of the fact that we are in a situation now where it actually is better to rent than buy. About 2 years ago, for the last 10 years, so about 2 years ago, last 10 years, it was almost a slam dunk. You can almost find a house for almost anyone that was cheaper to own versus rent. But right now, we can't do that. So the first thing is what I want to do again. I'm going to show you the true cost of refinancing, okay? And we're going to compare the mortgage payment to the rent payment. So if I buy the same house that I'm renting, hypothetically, the mortgage payment would be $2,900, which counts $635 in taxes and insurance. But I'm renting right now for $2,000 a month. So the first thing I have to do is show you when we purchase the loan, when we purchase the house, okay, we're going to start with the loan amount, which is not, okay, of $324,000, which is about a 5% down payment. So what I want to do now is let's talk about the fees and the equity growth over 1 year. So we're going to take a look at the 1 year breakdown of cost to own versus cost to rent if you refinance. So the first thing I want to do is go over the right section. So what you're going to see is the first year of owning, you're going to pay back $24,198 in fees. That's why there's a negative there. Now, as far as principal, remember, you're paying down your principal, so you are getting equity. It's not really equity, but the fact that you pay down your principal gives you more equity in your house. So after 1 year, you have paid down in principal $2,986. Okay. Now, if I do a 4% equity growth, which it's not in every market, but on average, let's say 4%, that gives you equity growth in 1 year of $13,608. Now, if we look at the payment difference between renting and owning, the difference in payment is $10,800 a year. Okay. So in other words, when all is said and done, if you owned, you will have hypothetically got $13,600 in equity. Okay. You guys follow me? So that's where I want you to focus on that. So if you own versus rent, we already know you're going to pay $10,000 more to own plus the down payment, right? You're going to be wasting your down payment. But ultimately, people are always like equity, equity, equity. That's why it's smarter to own, which is generally accurate. For the last 10, 15 years, it's like that. But now it's not like that no more. That's what I'm trying to explain. It ain't like that no more. So $10,800 difference in payment. Now, if we refinance, okay, and say we're going to refinance from a 7.5 into a 6% 1 year later. So we're going to go from 7.5 to 6% 1 year later. Remember, you guys, so we're going to start with a loan amount of $321,000. Why is the loan amount starting lower? It's starting lower because remember, you paid about $3,000 in principal off. And yet you pay $20,000 in interest. We won't go there. That's the top one, $24,000 in interest, whatever. But remember, so we're starting with a loan amount of $321,000. But remember, you guys, it costs money to refinances. Roughly 4% in fees to refinance. If you don't believe, I'm telling you guys for sure, even if you find someplace that gives you a great deal, you still have to generally set up your escrow account. Your escrow account, taxes and insurance. So generally, even though you get refunded whatever's in there based on an aggregate schedule, an aggregate adjustment, you're still going to pay it. So your loan amount's going to go up is my point. So your new loan amount, okay, at 6%, adding in that 4% in fees. Do y'all see that? So 4% in fees, which if we look, $12,840 in fees, how much equity did you guys get? You guys got $13,000 in equity. So the fees to refinance almost destroy all of your equity immediately. If you sell your house at 6%, again, you guys, when we look at the title, at title companies, you have to, in Texas anyways, California title is different than escrow and closing. But regardless, you have to set up an escrow account. Unless you have 20% down or 20% of equity on a conventional mortgage, then you have the option to avoid it. But nevertheless, your equity is gone. So the first thing I want to explain to you guys, your equity is gone. Now, your new loan amount, look at your new loan amount is now $330,840 because you roll in the fees. When you do a refinance, as long as you have equity, you do not have to pay out of your pocket. Generally, you can roll in all of the fees to refinance minus the appraisal. The appraisal is generally the only fee you pay out of pocket. So again, you refinance, you just threw away all your equity. You've given it to professionals in the industry. But nevertheless, if you refinance into a 6% at that higher loan amount, okay, your payment is $2,636. So let's look at, again, the real cost here. Okay, so when all is said and done, if you refinance, we're comparing renting versus owning. If you refinance, you're going to pay. Now I'm going to minus the $800 in equity, okay, because that was equity. Okay, here's your cost to own, right here, and here's your cost to rent, and that counts equity growth. Which means if I would have waited, that's an interesting little symbol right there. I'm not sure what that is, but that means if I would have waited, I could have saved an additional almost $24,000 if I would have waited. If I would have waited for what? Rates to be lower. And if I avoid refinancing. So again, what I'm trying to recap here is if you refinance, you just shot yourself in the foot because you have to start the amortization schedule all over again, which you just paid $24,000 in. and you have to pay roughly 4% in refinance fee. Now, again, there's some things like streamlines. FHA allows you to do a streamline. The interest rate's higher on that. And then VA allows something called an IRRL, IRRL, which is a streamline refinance. But I could tell you guys, for being in mortgage for the last 22 years, is 99% of people never do a streamline. It's always cash out refinance or rate and term refinance. So I hope you guys see the true cost of that. In other words, you guys, it's definitely 100% not a slam dunk. So we're going to go into our first video, which is going to kind of from a bull that's going to talk about how great the economy is. Now, after that, we're going to go into liquidity. After that video, we're going to go into a real estate update. I'm going to show you guys inventory and prices. And then we're going to go into a video from Jerome Powell, various sections from Jerome Powell on the 60-minute interview. But let me tee up the first video for you guys right now, and we'll get the show rolling. And if you guys can, let me know if the audio is okay. Here we go.
Blockbuster jobs report. More than 350,000 jobs were added in January. That was nearly double what analysts expected. And the unemployment rate held steady at 3.7%. This is just the latest positive sign for the economy, as Americans are finally starting to feel better about all of it. Just listen to Fed Chair Jay Powell earlier this week in a rare statement.
This is a good situation. Let's be honest. This is a good economy.
Not something you hear from him often. Joining me now, my dear friend Ron Insana, CNBC senior analyst. Ron, for months, people were debating, will it be a hard landing? Will it be a soft landing? It seems it will be no landing. This is great news. Very good news across the board. What is your assessment?
Unambiguously good news. And not only do we get a strong employment report, the unemployment rate now has been below 4% for 24 straight months. That is the longest stretch since the mid-1960s. Wages are growing faster than inflation. The Atlanta Federal Reserve puts out a real-time estimate of growth for the U.S. economy. In the first quarter, the quarter that we're in right now, it's expected the economy could grow as much as 4%, which is actually faster than we were at the end of last year. So no landing is the correct assessment at this point in time.
Even right-wing media sort of finally acquiesced throughout the day. You know, that normally they would say like, but this, but that. Finally said, you know what? The truth is the truth. The numbers are good. So you're hearing that, you know, so we often hear, well, people are told the economy isn't strong. That's now changing. There is so much good data that people can't say, well, it's not so good. Do you think people will start to feel it more?
Well, we're seeing it in the consumer sentiment and the consumer confidence
Which
data.
is up.
We're not seeing it in the polling because actually people are responding to the economy based on the party to which they belong. So if you're a Republican, you think the economy is not doing so well, at least according to the polls. If you're a Democrat, you think that it's doing better. I do think people are feeling it. Stephanie, stock market, new all-time high for the S&P 500 and the Dow Jones Industrial Average. Americans have over $6 trillion in cash in money market mutual funds. That goes to $8 trillion if you count certificates.
We don't know
deposits.
what that means.
They have a lot of cash on hand. So consumer spending can remain strong for some time to come, which means the economy is not likely to slow down anytime soon. So this is a not just a good economy. This is about as good as it gets. You know, back in the 1990s when wages grew faster than inflation, that was a really good environment, new all-time highs in the stock market. It's effectively what we're seeing. The one wrinkle is the fact that prices overall in a post-pandemic world are higher than they were before the pandemic. But employment's better. Inflation has slowed considerably. Wages are up. It's good news all around.
Not a wrinkle, but a risk. Let's talk about what's happening overseas. These U.S. strikes tonight, do you think they will stop the Houthis from continuing to attack cargo ships, right? Attacking those cargo ships is forcing those cargo ships to make massive turns basically around an entire continent to make their way around the world, which could definitely impact prices, worsen inflation, hit oil prices.
If it were to be a severely protracted series of events, yes, this could be a problem for inflation. I don't necessarily think that's going to translate in the way some people fear. Yes, shipping costs have gone up rather dramatically as a result of this. If indeed that activity does get tamped down and we start seeing ships go back through the Red Sea and out through the Gulf, and instead of going around the Horn of Africa, taking the more typical route that they usually undertake, then we don't have to worry too much about that. What's been interesting about this entire process, if you can call it that, is that energy prices Crude oil is in the low $70 range. Natural gas is around $2 per 1,000 cubic feet, and heating oil is even down, even though we've had a cold snap. So energy prices have not been affected by this. Shipping costs have been, but I don't think that's going to be in the long run a permanent problem for inflation.
And of course, we are pumping more oil in the U.S. than
Nearly
we ever
13.5
have
million barrels
in
per
the
day.
history of ever.
Interesting. Okay, so that is, we are done with that. Real quick, let me just get this off of here real quick. So a couple questions for y'all, and then we're going to go into a real estate update. I mean, are you feeling it? Are you feeling it? I mean, literally, I want you to comment below. Let me know. Are you guys feeling it? I'm feeling it. I don't think the economy is great. I think the economy is extremely unaffordable, and I think they're passing the unaffordability from the inflation and from the money printing onto normal, regular consumers that want nothing to do with the rat race and the corporate greed and all. They just want to live their life. So for the people that just want to live their life, which is most people, I think that we can feel it. Comment below if you guys can feel it. And I wanted to warn you guys real quick. Let me pull these comments up real quick. All right, so here we got what appears to be a realtor. Okay, so this is what he's saying. That's weird, David. I usually get my clients $8,000 to $10,000 in closing costs covered with new builds. So the first thing I want to say is yes, okay, you guys should get your closing costs. But then I'm going to show you what this guy has continued to say to our community and why you have to watch out for people just like him. They want to push us to buy, just like every realtor, but it shows in their comments. But anyways, they make a good point, right? So they start like, yeah, I'm a great realtor because I get $8,000 to $10,000 back in closing costs, which is great. Even if it's an existing home, I personally, every house I've ever bought, I've got the closing costs paid. Every house I've ever bought, every dime of closing costs are paid, and it's like $8,000 to $12,000. So that's good. But look at, he goes on and he says this. Hold on one second. Doom mongers supporting doom mongers. When you hear a realtor talking like this, run, because they don't understand what they're saying. When they're talking about doom mongers, isn't that the fear of missing out? Didn't we have a fear of missing out phenomenon we're getting out of? Didn't we have appraisal gaps and bidding wars? Do y'all remember that, realtors? Do you remember the fear that you've created to say, just buy, just buy, just buy? So instead of this person saying, hey, you got to watch out for PE ratio, payment to income ratio, yes, do a market analysis to review comps, they belittle us for being cautious. And the guys, here's the thing, they're a dime a dozen. Most realtors are just like this guy, talking out of their bums, for lack of better words. So anyone that's being pushy, which is most realtors, run from people just like this, because again, they will try to manipulate you by saying things that are great. But then when we see their true belief, we know that they're just pushing fear of missing out. Maybe I'm wrong. That's what I got from that conversation. Let me know what you guys think. But we're going to go into the real estate update right now. I think you guys are going to like this one. We got some good stuff to talk about, starting with inventory. Let me cue this up for inventory. Boom. Okay, let me move this picture for you guys. This is great news. All right, so we're going to start with inventory. And you see that it's just a little bit down from November to December. This should be updated like probably, I think it's going to be updated this week. But I want to point out, you guys, we have 714,000 active units. That's super low. Okay, overall, big picture here, that's low. Pre-pandemic, we had about 1 million. So we're close. We're about 290-ish away, but we're not there yet. But all we need is about 290. This is existing. But what I want to point out is people forgot to talk about like where we came from. Look at this, guys. If we go back to January 2022, January 2022, let's go to December. Okay. So because we're comparing December 2021, we had 445,000 units. That gives us a significant increase in inventory. So again, this time 2 years ago, all we had is 445,000. So the market's changing. Inventory is going up, which is the fourth cycle of the four. So we're definitely in the first two. Now the third one's price. But anyways, guys, and look at where we're up year over year. Let me show you. Okay, so year over year, we're up as well. We were at 680,000 units. Look at that. You guys see this? Now we're at 714. So we're up significantly year over year, not 15%. We're actually less than 15, but we're up significantly. So inventory is going up. And another point, this is our real estate update. Remember, I'm going to show you guys another point. This is messed up. Like, I get why some consumers like are so confused and have resentment and are bitter and don't know who to trust. Like, I get it. I understand why that is. One of the reasons is because the data is so all over the place, which is why I'm telling realtors, calm down. Stop using your emotion. America hates you. Start using the data to find the deal. Help communities, don't sell them. Do you see what I'm saying? Help them, don't sell them. Because we need you, realtors. We need great realtors, not some bums in the comment sections talking about fear when they're the ones that created the fear of missing out. We need great realtors that are using data. And let me show you again, just to add to my point here, look at how I'm going to show you guys 3 different data sources for Myrtle Beach. Okay, so we're going to look at Myrtle Beach price growth. And you guys, the discrepancy is absolutely disgusting. It's an abomination to consumers and the public. Look at how different this is. Again, let's start with Zillow. Okay, so here's Zillow. Here's Myrtle Beach. Y'all see that? So Zillow is saying Myrtle Beach. See this? Myrtle Beach is up. Okay, this is for December. So we're just going to December now. So Zillow is saying Myrtle Beach is up 0.4% year over year. See? Okay, right? Everyone follow me? So Zillow saying Myrtle Beach up, and I'm bringing this up because I went to Myrtle Beach and I was blown away. But Myrtle Beach is up 0.4%. But look at what happens when I go to Redfin. Okay, so remember 0.4, but Redfin says, look at this, 19.2. Redfin saying 19.2. Y'all, okay, let me show you again, okay? Can I get some bonkers in the comments? You guys feeling me on this? Can you just say bonkers in the comments so I know you guys get it? I need you guys to understand we're not just putting a tinfoil hat on. I'm showing you proof. The data is so deceitfully all over the place. I understand why consumers are struggling. I'm going back to Zillow. Zillow saying, as of December 31st, Myrtle Beach is up 0.4%. Yet when we go to Redfin for December, it's saying the median sales price year over year is 19.2 freaking percent, but it gets worse. Now, this is median sales price on a monthly basis. When we go to Redfin's 4-week rolling average, we can see, according to Redfin's 4-week rolling average, and this is why I look at the 4-week rolling average, Myrtle Beach is down 1%. So we have Redfin saying, if we look at 4-week rolling average, that Myrtle Beach is down 1% year over year. But yet when we have the monthly median, it's up 19.2%. You guys feeling me on this? That is a discrepancy of 20%. That is a 20%. That's a 20% price discrepancy from the same data provider. If we look at 4-week, it matches Zillow. So the 4-week rolling average from Redfin matches Zillow. But when we look at the monthly, 19.2%, are you whoa, massive discrepancy. So the question is, okay, inventory is shooting up. We know that we can't trust the data. Let's look at Black Knight. Let's look at prices. Let's look at year over year and month over month prices. Let's see what's really going on as far as prices, because that's also data that's all over the place. So I'm going to use this trusty little map here from Black Knight. This is going to be linked in my description and everything will be chaptered if you want to come back here. But here's our month over month change in home prices. And really what I want to point out is so far, the market has been a tale of two tells, okay? So we have the East Coast right here, which on a month over month basis, pretty resilient. Okay, look at that. Almost every metro area out east is going up slightly. Now, this is only to October because this data is lagging. So again, it is lagging. Now, look at Florida. Florida has remained resilient. I believe once we get out the December numbers, this is October. Once we get out December, you're going to probably see a decline here. But Florida has been fairly resilient. But look at Texas. Almost every major metro area in Texas right now is experiencing year over year price decline. I believe that's a direct result. Obviously, the massive equity run up, obviously the unaffordability, obviously net migration out of Austin, but new homes. New homes are blowing up at the seams in Texas. There are so many new homes in Texas, it blows my mind. But also look at out west. So you are seeing some cracks out west. We also have Case-Shiller showing decline, but you see it, you guys. You see it here, Seattle, Oregon. You see Northern Cali. You see a little bit southern. You see, Central kind of remaining resilient. Vegas has been resilient. We got Salt Lake basically going to go down. Denver is going to go down. But this is huge difference. So prices are going down. But the thing is you really got to focus on subdivision. Remember subdivision right now. It's all localized because it's not yet collapsed. But look at annual home price growth. So this is year over year comparison. They have not given us the peak to current comparison, which will show you guys the true, tell of the tell. And I'm going to say another thing, guys. We don't even have price discovery yet. I was hoping for price discovery in 2023, and we were on our way to price discovery in 2023 until the Bank Term Funding Program rolled out in March of 2023 and deflation stopped. So we don't even have a price discovery yet. This is absolutely bonkers. Look at this, guys. But as far as year over year, Black Knight is basically saying only in Texas is year over year, some Louisiana as well, and it looks like Salt Lake City. So there's a lot of changes going on right now. Obviously, we know that. What I'm trying to say is I don't even know who to use for data. I do know that Redfin is, in my opinion, it's all my opinion, and based on like my observation, I've just made a video, they're manipulating the trajectory and they're adding new homes to their data. You can't compare existing homes for the last 3, 4, 5, 6, 7 years, and then this year and the end of last year, you just throw in new construction. I mean, seriously, guys, how does that make sense? I mean, seriously, that's completely ridiculous. I've shown you guys that inventory, regardless of what you're hearing, is going up. Demand is absolutely slaughtered right now on pretty much every data set. So things are changing. Who do you believe? Who do you listen to? So the first thing is now we're going to go into the video from Jerome Powell. I'm going to kind of break it up a little bit, and we're going to hear what Jerome Powell is saying as far as interest rates, his target 2% inflation goal, restoring price stability, the fact that he may not even do May rate cuts, and they need more good data. So let me get this queued up for you guys right now. This is going to be a little bit different because I had to make bookmarks here. So let's start this now, and I really hope you guys enjoy. This is a 60-minute. So they do expect to see that, guys. I mean, that's pretty much the whole interview. They're not. So what I heard in the interview is essentially that he ain't gonna do nothing to rates until the economy starts to bust, starts to unravel, until unemployment goes up, obviously. Now, we're going to go into the job data as well. I have that for you guys. But before we go into jobs data, let's go into the liquidity because remember, the liquidity is kind of like, or the money is kind of like keeping things like propped up. Right. So it's important to watch what's happening with, obviously, with the money. But before I go into liquidity, let's take a look at the yield curve inversion. Now, the yield curve, excuse me, the yield curve inversion is one of the leading indicators of economic uncertainty. Really wanted to say thank you, though. Oh, my gosh, my hair's all messed up. I get pimples, too. I'm in my 40s. What the heck? Wanted to give a shout out, though, to Don't Move in Texas. Thank you for the support, brother, from the very beginning. When I make it to Austin, I'm hitting you up. We're going to get a dinner or some coffee or something. I love you for all your support, man. From one man to another. Thank you, brother. I appreciate that. Now, real quick, where's that other comment? Boom, boom, boom. Where is it? Okay. So here's the realtor again. He's saying, so preach the whole market will go down as baseless. But, you know, I think your assumptions are baseless because I've went on the record many times to preach about the whole market. I don't know if you understand Merino racing. I don't know if it sounds like you should probably stick with racing instead of being a realtor, but we have yield curve inversion. I'm going to go over that right now. That spells historically a collapse is coming, a warning is coming. Do you understand the yield curve inversion? I'm going to show you right now. But also, what else have I talked about, Marino? I don't know if you're paying attention, but equity growth. The equity run-up was bigger. The bubble, equity run-up, right? That's what that means, is bigger than the GFC. The GFC took about 4.5 years for home values to explode. Right now, it took about 2.5 months. So we have the bubble, but also unaffordability is worse than the GFC. Sales are worse than the 1990s. The whole market is down, brother. It's the lowest it's been since the 1990s. We're just still waiting for the price. The market is shut down. They've locked the market up. We don't have price stability. We don't have price discovery. All right. Anyway, sorry. Don't mean to rant, but my God. You guys see why we have such an issue with the realtors? I mean, you know, stick to writing contracts or something, brother. But I appreciate the comments. I really do. And if you really feel that way, I'm sorry. I didn't mean to make fun of you. But dude, you represent people trying to purchase the biggest transaction of their life. And that's how you're going to talk to people? This is the biggest transaction of most people's lives. The American dream generally starts with home ownership. And that's the attitude you're going to have. Check yourself, man. That's all I'm saying. Anyways, take a look at the yield curve inversion. This is the biggest sign, the biggest bearish narrative right here. Like, this is what we have on our side. Yield rate, the yield curve inversion. You guys, we're still inverted. We've been inverted for over 19 months. I think the record's 21 months. It makes sense when I really step back and think about this, that we've been inverted this long because there has been so much money pumped into the system. and deficit spending, government deficit spending. But this is at 33 basis point. Probably when we end today, maybe it'll be 4 or 5 basis points closer, but it's probably not going to be a heck of a lot closer because, again, you have the 10-year. Oh my gosh, look at this. It's up 12 basis points now. And then let's look at the 2-year. 2 years at 9 basis points. So the difference is 3 bips. So again, that's why I say 3 bips on that because the difference there. Now, take a look at this. Going back into the liquidity, you guys, here's the reverse repo market. Okay, this is a ton of money, right? This is where, one of the reasons I feel like my forecasting has been off. I didn't take into as much consideration the power of the reverse repo market being an indicator of excess money and excess savings. This is plummeting rapidly. Now, I suspect that this is going to be gone maybe in about 3 months. So some people have been saying about it since February. I'm saying probably May. I think it's going to be May. But look at how much this has been going down. So that lifeline right there is almost done. This is good, right? But there's still $513 billion in liquidity. I mean, let's be real about that. That is a fact. So there's still a lot of liquidity, but look at the trajectory of it. Look at how fast it's getting burned. Y'all see how fast? I mean, it's getting burned alive, guys. The reverse repo market is draining. However, take a look at the Treasury General account, okay? Funny how we have so much deficit spending and yet we have all these reserves. This has been going up, actually, surprisingly. We're at $841 billion on the Treasury. So hopefully they won't have to get in more debt, but you already know that they are. Well, they're going to, obviously, but that's at 841 billion. So again, liquidity, we still have 513. Treasury has about 841. So there's main liquidity. Take a look at the money, guys. You can see, again, as of October, we kind of stopped losing the money out of the system. It's been going up relatively slow, kind of being balanced. Let me zoom in on the 1 year so you can kind of really clearly see it here. It's actually about November 6th. So the money supply has been going up. That's probably why the stock market's at an all-time high, to be honest with you. So that's not an indication of a recession. The money supply is going up there. Keep your eyes on the M2 money supply. Let's move on to, what's this? Oh, this is a federal surplus and deficit. My God. I was going to go into the deficit. I mean, the deficit spending right now, guys, 6.19% of the GDP. I mean, my God, right? Like we're really in bad shape right here. We're really in bad shape. I just want to throw that up just real quick as far as that deficit. I forgot to do my timestamp on my liquidity. I'm really sorry, guys. So what I want to do now is let's go in and take a look here. I'm going to set up one more. This is going to be our last video. Oh my gosh, Dow drops 400 points. So the market's starting to price in no rate cuts. Okay, so the market's starting to wake up. I mean, the over-optimism, Dow's down 400 basis points. So we're going to listen to this last video, you guys, and then I'm going to go into, this is on the jobs report. So this is going to go into how great the economy is because of the jobs numbers. And then I'm going to end by going into the jobs numbers. And then again, in my market analysis, I'm going to do that for you guys. But if you don't mind, let me know that the volume is okay and enjoy.
The country, Mark Morial, former New Orleans mayor and now president and CEO of the National Urban League. It's great to see you, Mark. We try to figure out we try to juxtapose these numbers with the feelings of a lot of Americans, and we struggle with that. And maybe you have a good insight into it. I think, when you have a couple of years of tough inflation, the prices don't come down, inflation moderates, but people still feel like their paycheck's not going far enough. I guess real wages are growing now, but that's been relatively recent, I think since last May or something. And so people still have less buying power than they did from a couple of years ago. Does that explain things?
First of all, thanks for having me. What's striking about this report is how it beat every single expectation from every, if you will, economist in the country. No one predicted a jobs report like this. And what I would say, and I'll address your question, is the professional economists have, and many watchers have predicted pretty consistently for the last 3 years that we would have a hurricane, a tsunami, a tropical storm, or heavy rain when it comes to the economy. They didn't predict the sunshine of consistent job growth and now lessening inflation, increasing consumer confidence, I heard many of the business leaders who were on this morning express optimism about 2024. No one expected that. There is a hangover from COVID and the recession, and Americans are feeling that pain. But let's understand that one of the biggest challenges we face when it comes to Americans' ability to afford to live at the quality of life they want is housing costs. Mortgages are up, rents are up, it's expensive. It's expensive for young professionals. It's expensive for working families. It's expensive for single moms. It's expensive for mature couples to be able to have quality housing. And there's an issue Washington and the private sector should confront, and that is we need a housing strategy that produces more affordable units, that produces more housing in this country, because the 20-year trend is now impacting and affecting us. So against this powerful report, I mean, this, I saw every prediction of 175, 200 maybe was optimistic. Now we're at 350 and the consistency of it. So we should take it as a positive report, but we should understand what really is driving the pain for many Americans. And it is, I think, inflation when it comes to housing and the cost of a basic necessity of life.
Yeah, that's certainly something that one of the pieces of the puzzle trying to understand this upcoming election, Mark, because you would think that the president's numbers among minorities and people benefiting from things would be at historic levels, and that's not the case. It's constantly pointed out that if it's former President Trump, that his numbers have actually been increasing, where it doesn't follow with what you just described to me in terms of
I always
why.
tell people it's dangerous to read too much in early polls. If you followed early polls, Obama would have been beat, Clinton would have been beat, George Bush 43 would have been beat. These early polls, I think people in politics, we all follow them. But what will count is where this election is come August and September, when people really kick in, when campaigning and advertising begins. But there's a long-term, sort of sense that we're on an economic roller coaster. We had the Great Recession of 7 and 8, then we had a recovery. Then we had COVID and the impact of that. So I think what many Americans, I know Americans in Black communities and brown communities, unlike every other American, want is stability, economic stability, not chaos, not confusion, to give them an opportunity to build their personal finances, build their balance sheets, build a secure future. So I just think people should step back and say, this is a good report. And look, when it comes to these reports, I mean, people tend, I looked at the Economist panel, I think people spin it depending on where they stand politically. And we should factor that in. But I like to call it as I see it. It's a good report.
I like to call it like I see it. So let's go into that report. Isn't that a good idea, guys? Here, let me tee this up, and I got to prepare because I have to do the market analysis as well. Let's tee this sucker up right here, okay? This is hard to see, but I have it all written down for you guys. So let's see how good this report really is, because we really want to, well, first of all, again, the GFC, we didn't even have part-time jobs. So I will say that, like, the labor market right now compared to the GFC, you really can't compare it. Right now it's softening, it's starting to crack, but the GFC, you guys, we were in such, it was such dire straits. So we don't have that yet. So really all we could do is look at full-time jobs, part-time jobs. And if you look here, first of all, I want to remind you guys, the last data that we read in December, we lost, you see this right here, from here, I don't know how well you guys can see that, to here, we lost 1.53 million full-time jobs. That is not a sign of a strong economy, obviously, right? That's not a sign of a strong economy. I think we can all say that. So January is all the way on the right here. Okay, so now, and obviously, you guys, we gained 63,000 part-time jobs. So you see the part-time jobs, we gained 762,000 part-time jobs. So in December, we lost 1.53 million full-time, but we gained 762,000 part-time jobs. First of all, again, softening labor market. It hasn't fallen apart yet, but that's not healthy. Now, when we look at the January numbers, so when we compare December to January, we actually have for part-time jobs gained 96,000 part-time jobs. Now, full-time jobs we lost, so we lost again 63,000. So we lost 63,000 full-time jobs and we gained 96,000 part-time. And also what's very interesting, guys, is if you look at the revisions are super duper bad. I want to show you also something because I've always wondered, like, how much is government jobs manipulating this, right? Like, can we get a breakdown of how much the wages are in government jobs and things like that? But here's what I wanted to show you, government workers. Okay, so government workers, look at the unemployment rate, 1.8%. So it's kind of fair to say that it is propping up the numbers because look at how low the unemployment rate is when it comes to government workers. Now, I thought that was interesting. And I also felt like construction was interesting. Construction has 6.9% unemployment. What do you think it's going to be when the market really slows down in construction? This is probably going to be one of the first things that like explodes construction. So we're at 6.9. It's not double where it is on a nationwide average for all jobs, but it is super high, obviously, guys. So we don't have the strongest labor market, but to say that it's not resilient when compared to GFC would be misspeaking, in my opinion. Now, what I want to do is let's talk about how to find a great deal. And the way you do that, guys, we're going to do one of the easiest ways to do that. If you guys can give me a subdivision, that would be awesome. Someone, if you're in the Houston area, give me a subdivision. I'll look this up. But remember, if we want to really find out whether or not there is a wedge in a property, we need to look at comparable data or homes that have sold, and we have to keep it localized in the subdivision of the property. And remember what wedge means. That just means equity. And honestly, if you can buy with equity right now, you're going to be in a way better position to potentially handle price decline. So if you walk into a house with 20% in equity, but home prices go down 15%, you're a little bit better off. Okay, so I have someone here that said Cinco Ranch. Okay, so we're going to do Cinco Ranch. I'm going to show you guys a live market analysis. Let me write this up here, Cinco Ranch. All right. So if you're a realtor, pay attention here. And if you're a consumer, pay attention and hold your realtors accountable. I have to switch to this screen, okay? So what I'm going to do first is we're going to look up, see, I can't do California, Johnny, darn it. But we're going to look up Cinco Ranch right now. So I'm going to put in Cinco. Man, this microphone's really in my face. I don't like that. Let me move this back a little bit. Cinco Ranch, okay? Because remember, we want to be localized. So here's the subdivision of Cinco Ranch. Now, first, let's pick a property. So let me go to results. I'm going to just pick a property here. Let's take the property that's listed for the lowest price per square foot. Okay, so the lowest property in Cinco Ranch, oh my gosh, is listed for $600,000 and $158 a square foot. Okay. I don't like that. Let's just do the second one. We're going to do the second one because it's smaller. Like that one's kind of a one-off. So we're going to go to the second one here. This is the analysis going to be here, okay? So we have $159 a square foot. The listing price is $377,000. I'm going to click this here in a minute so I can find out my taxes and insurance. All right, so let's take a look at this property right here. So 159 a square foot. Okay. So I'm going to go down here. We're going to look at the property taxes real quick. Shoo! $8,000 a year. So we're going to add $1,500 for insurance. So we'll say $9,500 in taxes and insurance. Is that brutal or what? All right. So here's what I have come up with so far. Let me see if I can actually do this. Let me see. Better yet, let's do this. And then like, that's not going to work. Okay. So I'll have to do it like this. All right. So we know that so far we're just getting information. Okay. So now what I have to do is go. So I'm interested in this property for $377,000. It's selling for $159 a square foot. Now I want to know, is there a wedge? So I got to go back here and I got to go back to my matrix. I put in the same subdivision. Darn it. That's the link to join the StreamYard. That's not the subdivision. So I'm going to put in Cinco Ranch. And this is all you guys have to do. I'm telling you, this is one of the most important things a realtor can do for you. And it doesn't take that much time. So we're going to Cinco Ranch. And I want to look at the sold property, okay, for 2023. So I'm going to go January 1st, 2023 to December. Dang it. Sorry, guys. To December. I'm not sure why that happened to December. 31st of 2023. So we're looking at the entire year of 2023 for Cinco Ranch. You guys can't see it, but it shows me 484 homes have sold. Now, this is a general way to do this. Again, if you're really interested, like if I was representing a client, it would be way more detailed, but we have 484 houses sold. So I'm going to select every single house. I'm going to go to stats on the bottom here and go to tabular. So it sums it all up for me. All right. And it's going to tell us our square foot average for 2023. Okay. So let me write this down. So for 2023, average price per square foot was $167.98. Okay. So we got a huge piece of the pie right there. All I'm going to do, you guys, is I'm going to compare. All I'm going to do is compare 2023, so you guys get a hold of this. So the first thing what we're going to do is we're going to look at the wedge. I'm going to pull this back up for you right here. Okay. So now that I have this info, we're going to calculate wedge, because again, I have the average price per square foot in 2023. Now, what I forgot to do is get the price per square the size of the house. So the size of the house was 2,364 square feet. So this is the size of the house, okay? So what I do is, to figure out wedge, is I multiply the square footage of the house by the average square foot of 2023. Again, this is just a roundabout way to do that. So I'm going to take $2,364 and multiply that by the 2023 numbers of 167.98, which means that gives me a total of $397,104. Okay. Now remember, I picked the listing in Cinco Ranch that was the lowest price. So obviously the lowest price is probably going to have the biggest chances of wedge. So now in order to find wedge, I take this number, which is the 2023 number, and I subtract it by the listing price. Okay. And then I get my wedge. This is a roundabout way. Obviously I get my wedge, which is, for that property, $20,104. Now, if I divide that in by 377,000, that means I have about 5.3% wedge. Okay. That's how you come up with wedge. It is very, very easy. You look at comps. Obviously, if I was getting super serious, I would remove outliers like super small houses or super big houses to get it really condensed. But so far, what that tells me is that listing in Cinco Ranch, the second cheapest one, has about $20,000 in wedge, or rather, it's about 5% under market value based on 2023. Now, this is what we have to figure out. So we figured out wedge. Now we have to figure out cash flow. Okay, the first thing we need to figure out when it comes to cash flow is our mortgage payment. So if you're working with a loan officer, they should be able to calculate property taxes and insurance and things of that nature. Okay, we have $9,500. So what I'm going to do now is I'm going to go and take you guys to this screen. This is our mortgage payment calculator. You have to hit include taxes and insurance, put the home price, which is the 300. Okay, I'm going to go after a 5% down payment. So 377,000 times 0.95 would be the loan amount. So 358,150. So 358. Okay, so we go 358,150. Man, that's not okay. I just put the home price in here. I didn't have to even do that. I'm going to switch the down payment to 5% right here. You guys can see that. I'm going to change the property taxes and insurance because I have it. I've added it all up. Total is $9,500. Okay, so I have that in there. Y'all see that? 5% down. I'm going to say I have great credit. So the interest rate is about 7%. So that gives me a mortgage payment. I hope you guys understood how I did that. It gives me a mortgage payment now of, okay, so mortgage is $3,385. Okay, so now what we have to do, I'm going to tell you guys right now, this is not going to work. What we have to do now is figure out if we can get cash flow. The way we figure out if we can get cash flow is we run now comps on what houses are renting for in the subdivision. So let's take a look at that right now. Okay, so we're going to go back here. Okay, we're going to go back to search, but we're going to go access the rental matrix. Okay, and we're going to go to the subdivision that says Cinco Ranch right there. And I want to see the last year. Okay, so I'm going to look at the last year, 360 days. So as I'm doing this is a tad different. In Cinco Ranch, there was, dang, that's crazy. There's 392 homes listed for rent that actually went up for rent. So let's look at the results. You see 392 homes were rented in Cinco Ranch. I'm going to select all of the data now. I'm going to go to stats. I'm going to go to tabular, and let's see what our average price per square foot is. So our average price per square foot is $1.15. Okay. Let me show you guys. Let's go back here now. So I put $1.15 a square foot is what it rents out for. So now what I do is I multiply $1.15 a square foot by the size of the house right here. Okay, and let's see what we can get in rent. Okay, so I'm going to go $2,364 times $1.15, which gives me in rent. You guys ready for this? Okay, your rent is going to be, this is bad, $2,718. And this is this isn't even counting like repair costs and property management costs. So this means that if you buy that house as is, only 5% down, you're upside down. You have negative cash flow. This is the devil's sign here to be patient. Okay, this is a sign from the devil. Be patient. You have negative cash flow of $666. So all of this is just a number game. That's it. It's just a number game. So any realtor that says that's not bad is out of their minds, completely out of their minds. So let's recap, okay? Sorry for that slight blow there, or slight attack there, Marino. I really appreciate you commenting, man, because it gives us perspective and the ability to sharpen our own perspective. But that comp I just did real quick, that took me like 15 minutes at the most. That's exactly what your realtor should be doing for you if you're interested in a property. We know that if we bought it as is for the listing price, we have about $20,000 in the wedge. However, if we only put 5% down, we're upside down $666 a month, which means if we ever had to leave for any reason, we're upside down $666. The reason for the cash flow is if you ever have to move. You can't tap the wedge. Even though you walk in with $20,000 in a wedge, you would have to sell it or refinance. But remember, I just showed you the fees. So $20,000, okay, yeah, it's not that good. I think that right now, you guys, the market's so toxic. The more you use the fundamentals I just showed you as far as that wedge or equity and that cash flow, I think you're going to be better insulated. I think that's a fact. That's why I'm showing it. And that's why I made that home buying course, which reminds me. Let me show you guys something real quick, and then we are going to get out of here. So just one more time, y'all. I'm going to throw this up real quick. Now, if you guys need to get a hold of me, I'm starting to do a better job. I'm getting into real estate a little bit. I have a client I'm representing. I'm trying to keep them cool. But if you guys need to get a hold of me, I have everything now under my About Me section. So I have my Twitter account right here, which I suck at. There's the Discord. If you guys want to join for free, whether you're a realtor or not, join the Discord if you want to help some people out and just really talk after the video. Here's my free home buying course. So if you click this link, it's going to take you right to the free home buying course. Here's my email. And if you have anything dire, you don't want to go to the Discord, you don't want to use any free information, you can always get a hold of me by doing some one-on-one consultations if you click that as well. So anyways, guys, that is going to do it for my presentation. Let's see if we got any questions real quick. All right, so let's see here. Let's see. I come for, oh my gosh. Dude, Maria, he's still over here. I mean, how am I supposed to take you seriously? You don't even pay attention. We just went over the cost to refinance, brother. My God, man, like you're complaining and you're a realtor instead of like helping. Come on, man. Just help a little. I appreciate your comments. So I don't want to like suppress you or anything. I feel like everyone should, have their saying things, but it's just there's different levels of stupidity is all. All right, let's see here real quick. I mean, here's a comment. This is the first thing. We're going to do some Q&A. So this is from Billy Bob. To Marino, have some foresight. Are you 32 years old? And the reason I starred this comment is remember how young a lot of these permabulls are? We went to a Wall Street in New York, and almost every broker that was coming out of Wall Street was in their 20s. You guys, I'm going to be honest. This is no knock necessarily if you're young. I'm not knocking you if you're young, but I am saying that you have never been through a cycle yet. And yet you're an expert, but you've never been like, you're used to like aggressive money printing. You're used to an aggressive job market that's begging you. They're begging you to work for them. That's not normal. That's not normal. And so like, I think that there's some brilliant young adults for sure. I think there's some brilliance, but Obviously, if you don't go through it, you don't have the experience. And if you're talking about it, you don't have the experience, it's hard to take that seriously. I mean, your adult life, you've not gone through it. I don't know if they're 32, but they're, from the way they're talking, they're probably young. Here's from Jason Perry. Inflation will never stop until the government stops deficit spending. It's impossible. And that is a huge factor in why things are propped up. I mean, if you guys really look at the deficit and the government spending, and you take that out of the equation, obviously, we know this by now, right? And this is the bulls refuse to talk about this. The economy comes crashing down. We have an economy that is based on consumer spending, reckless consumer spending, and reckless money printing from the government. That's how the economy has been working. So I hope, Jerome Powell, I hope you break the Fed put. The Fed put is the government's just going to bail you out. That's what the Fed put means. Hopefully he breaks that. Here's from Zenial Guy. Appreciate you, man, for all your support. There you heard it, folks. He just said they need the power of having rates at higher percent. Exactly. We will never see 0% Fed rate again in our lives. I hope not. And the reality is these high rates aren't the bad thing. The bad thing was the low interest rates. It was because of the low interest rates, topped with the money printing, topped with quantitative easing, meaning the Fed was buying mortgage-backed securities to continue to have much lower interest rates. That destroyed us. It destroyed the prices. It caused outrageous runaway inflation. Low interest rates are bad. Low interest rates are to stimulate the economy. The problem is they were stimulating an economy that was already stimulated. We already did money printing. They should have switched it after 2020, but they didn't. They made it worse. And that's the problem here. It's very, very difficult read. Appreciate that comment, brother. Here's something from Ray Taylor right here. So anybody that bought a house when interest rates were very low is stuck if they can't sell. So not necessarily, because you have to ask yourself, when were interest rates low? If you purchased a property prior to 2022, the odds are you not only have a low interest rate, you also have $100 or more $1,000 in equity. So if you purchase generally speaking, prior to 2022, you're sitting in a good situation. And so in that sense, you're not necessarily stuck, like trapped to sell. You can sell, you can cash in, you can pay off your debt, you can rent, you can do whatever you want. But understand that like pre-2022, home ownership was completely different. Home ownership these days is very, very toxic, high rates, no equity growth. But back then, equity was still going up. In fact, I was still helping people in 2021. I try to buy, I put in 3 offers in 2021 myself. It wasn't until really 2022 it started where I was like, I can't do this anymore. I got to sound the alarm. That was right before quantitative tightening happened. Good question and comment. We got living in Omaha, spitting insights today. Appreciate it. Have you considered more buyers or buy multi-generational homes, keeping prices elevated? I mean, the thing is, man, I think the bigger thing here is living in Omaha is the prices are elevated because of the lack of inventory and the lack of buying demand. So the only people that are buying right now generally are well off, and the well off people are generally purchasing higher price points, investors purchasing the lower price points. So I think really what the reason we're seeing prices hold is because of that lack of inventory being outweighed by the lack of demand. So even though we have this massive lack in demand in 2023, it was still lower than inventory. And that's why you saw prices pretty much hold overall. Plus liquidity injections, bank term funding window, program, all of those things took into consideration. Here's a comment from Marino. See, Marino, I'm trying to show some love. Most my buyers have over $100,000 in equity since buying in 2021. Exactly. Yes, correct. But I want to let you know, Marino, it's 2024 right now. Okay. So as long as props to you, man. Most realtors, they can't talk. There's like most realtors are stuck in 2021. Most realtors are bidding wars, all this type of stuff. It's 2024. The market's completely different. You get that, right? You can understand that, right, buddy? You get the market is completely different. Like, again, 2021, people were still winning. As long as you get through the bidding wars and appraisal gaps and waiving contingencies, if you were willing to put up with that absolute clown show, you may have won. I wasn't willing to put up with it, even though I did put in 3 offers. Okay, here's from Dave Rave. These things take time. That's why it's called the lag effect, guys. That is one of the biggest concerns in the market is the lag effect, meaning quantitative tightening hasn't fully gone through the economy yet. So Dave is saying, be prepared. Prices will drop big time. Don't be cocky because it hasn't happened. Young adults that have never gone through this, don't be young. This is for you young adults that have never gone through anything like this before. Chill. Like once we're uninverted and we have officially got, like, and there's no recession, sure, celebrate. But y'all are celebrating when we're still doing quantitative tightening. Hello, wake up, right? Anyways, so this is Jeff saying the reverse repo market's going to be done in March. I said May. We'll see what happens, Jeff, but Jeff is saying March. Don't move. He just got his loan officer license. Big props to you for passing that. This guy's in financing. I'd love to do an interview with you. Don't move. I think you have incredible insight. I wish you were back on Discord more. I know you got a new job, but yeah, they're not projecting 6 cuts anymore. So one more from living in Omaha. Really appreciate you living in Omaha. We are still getting multiple offers on homes above 500,000. So now I'm putting this up here because I appreciate your comments, and you have some good comments, but brother, you are falling into the trap of what the bad realtors that are spreading fear of missing out. And this is my point. A good realtor will explain the circumstances. I've been doing this for 22 years. You can't just say homes above 500,000 getting multiple offers. Are they getting multiple offers because they're priced under market value? Or are they getting multiple offers and the prices are still elevated? You still have bidding wars on overpriced houses. I mean, you got to help paint the picture here, brother. I mean, you have MLS access. You're saying you're seeing multiple offers on homes above 500,000. Is that all homes? What's the average days on market? Are those homes you're seeing that under market value? You see what I'm saying? Like, tell us what you're seeing, okay? Why you're seeing it. So because I have a lot of faith in you, honestly, living in Omaha for sticking around so long. I want to see you excel, brother. I want to see you help people. You know what I mean? That's my point I'm trying to make. Explain what you're talking about. What do you mean you're seeing bidding wars on above 500,000? Give us the specifics there. That's my point. Don't fall into like some of these realtors, man. You bring up good points. I don't want to see you fall back. I want to see you fall forward. All right. So let's see, you guys. I think that's about it. I forgot to do the timestamp. Darn it. On the Q&A part of this. I'm going to start crying right now. I can't believe that. I've been doing so good on my timestamps, y'all. I think we did our market analysis at 1 hour and 5. Okay, let's see. So how's our market weather driven? I don't know, man. Don't move. I can't wait to see you on YouTube videos. Hey, there you go. Don't move. You got Johnny. Where's your channel, Johnny? Put your channel link in the description. Johnny's been promising us videos. He said, we do videos. We do everyone on Discord. Like, yeah, let's go, Johnny. But we ain't ever seen no videos. Johnny, where's your videos, man? I love to listen to you. I love listening to you. Let's see here. Marino, I'm telling you, man, like it happens to me all the Marino, I think you're the one that's being salty. I mean, you're literally trying to talk trash on people with no bearing for it, no facts. But yes, man, like, okay, so being an influencer on social media is crazy. I have people look me up all the time, man. I mean, it's just something you got to deal with. Sometimes it's scary though. And you got to deal with that. But Johnny, definitely to your profile, dude, that's the first thing people do. They go to your profile to check you out. Let's see if we have anything else here. Finance and debt will plummet. Yeah, aren't smart enough to do their own due diligence. All right, guys. How are you supposed to give full details on what he's saying? Okay, how is he supposed to give full details on what he's saying? Because he's a realtor, Davey. Because he has access to the MLS. He could do a market analysis like I just showed you 30 minutes ago. He has a license. His job is to provide data and to understand local housing market. But I understand your question because that's not what most realtors do they? Most realtors are just cheerleaders pushing fear of missing out. Have a blessed day, Dane. I appreciate you. I think that's it, guys. I think we're done for today. Let me just, this last thing, be patient. Being patient is not easy. That's why it's a virtue, but definitely going to be worth it. They keep trying to prop up the market with FHA programs. I mean, yeah, I know. I get it. But you can, Marino. I mean, you've literally made like 10 comments. Like, I get it. But you guys, here's what I'm really trying to say. Whether it's Marino, whether it's my man living in Omaha, like we need these people. We need living in Omaha. We need Marino. All right. I'm pushing against you guys because you're here and I'm all your peer. We need you guys to help. Provide the data. Don't provide the narrative. Provide the data, not the narrative. I want you guys, especially Omaha, he's been around so much. I mean, you guys come to the Discord, help us, give us your market analysis. Tell us what's going on. Johnny's crazy. Peace out. I appreciate you guys. Have a bonkers day. Love you guys so much. Hope you guys have a great week. Don't use your emotions to buy. Study, study, study. Work hard. Remember to be an unreplaceable asset. Remember, One of the few of the most important things in life is your time and your relationships with people. Show some love. Say, hey, I'm a part of Real Estate Mindset. We show love to people. We don't belittle people. We don't put people down unless you're a realtor, and I'm working on that, and I'm sorry. Or if you're an investor taking advantage of people, I'm sorry. But the thing is, man, we want to love people. I want you guys to help us. I want us all to grow better. I put my money where my mouth is. I have the free home buying course. You guys sign up for that. But I'm going to get out of here. I absolutely love you. I'm going to come back, put chapters on. And if you're out there investing in real estate, you guys already know I wish you luck. And I hope you win.